let me welcome you all to the 102nd press briefing of the Monetary Policy Committee and the 5th for the year. The MPC met last week to deliberate on recent global and domestic macroeconomic conditions and to assess risks to the inflation and growth outlook. Below is a summary of the developments and key considerations that the committee took into account in arriving at its decision. Since the last MPC meeting in July 2021, the global economic recovery has continued, notwithstanding the spread of the COVID-19 Delta variant and production constraints stemming from supply chain bottlenecks arising from the pandemic. The International Monetary Fund projects global growth of 6% in 2021 and around 4.9% in 2022, supported by policy measures and vaccination programs which have allowed the removal of restrictions and reopening of more economies. Although the global economic outlook points to a rebound in 2021, these forecasts are subject to the evolution of the COVID-19 pandemic, including the spread of the emerging variants of the virus and the pace of vaccination campaigns around the world and continued policy support. Global financial conditions have broadly remained supportive of the recovery process, largely due to the continued accommodative stance of major central banks. Policy rates in major advanced economies are expected to remain low, despite emerging inflation pressures and stronger growth rebound. Yields on longer-dated bonds have declined in recent months amid concerns about the potential impact of the Delta variant of the COVID-19 virus on the global economic recovery, while sovereign spreads in emerging markets and developing economies have remained relatively compressed. The U.S. Federal Reserve has now provided more clarity on the timing of scaling back its asset purchase program, indicating that it is likely to begin in November 2021 and complete the process by mid-2022. However, previous uncertainties associated with the timing of the tapering of asset purchase programs by the U.S. Fed and other central banks in the advanced economies have weighed on equity prices and capital flows to emerging markets and developing economies, exerting some downward pressure on local currencies. Global price developments data show a sharp rise in headline inflation above target in several advanced and emerging market economies on account of higher energy prices, disruptions to supply chains, and increased aggregate demand pressures as economies reopen alongside supply-side constraints. There is, however, the general assessment that headline inflation will revert to target over the medium term, supported by continued slack in labor market conditions and restraint in wage growth. These developments, the recovery in global growth conditions, the tightening of global financing conditions, and rising global inflation trends are likely to have spillover effects on the Ghanaian economy, mainly through their potential impacts on trade, portfolio flows, financing, and exchange rate developments. On the domestic economy, developments continue to point to sustained recovery in economic activity following the downturn at the peak of the pandemic. The latest data from the Ghana Statistical Service indicate a stronger pickup in the annual GDP growth to 3.9% in the second quarter of 2021 from the 3.1% recorded in the first quarter and a 5.7% contraction recorded in the same period of 2020. Non-oil GDP for the same period grew by 5.2%, compared with a contraction of 5.8% recorded for the same period in 2020. The stronger growth performance in the second quarter reflects the sharp rebound experienced in the cocoa subsector, which grew by 27.6%, supported by equally stronger growth of 18.7% in hotels and restaurants, 13.8% in real estate, and 10.7% in trade. This stronger performance was, however, moderated by a contraction of 18.9% in the mining and quarrying subsector on account of a 10.8% contraction in the production of oil and gas. The bank's update of the Composite Index of Economic Activity for July 2021 reflected continued recovery in domestic economic activity. The real CIEA recorded a 20% year-on-year growth in July 2021 compared with 20.2% in June 2021 and a 3.9% growth in July 2020. The growth in the indicators were somewhat broad-based, with port activity, imports, domestic VAT, and air passenger arrivals accounting for the increase. The Ghana Purchasing Managers Index fell in August 2021, mainly on the back of rising input costs. The decline in the Purchasing Managers Index was consistent with the results of the bank's latest confidence surveys conducted in August 2021, and which indicated some softening of business sentiments. The survey results reveal the inability of businesses to meet their short-term company targets, driven by high input costs, unavailability of raw materials, weak consumer demand, and rising labor costs. Consumer confidence, on the other hand, improved, reflecting optimism about current and future economic conditions. The pace of growth in total liquidity moderated in August 2021. Broad money supply, that is M2+, increased on a year-on-year basis by 20.2% in August 2021, compared with 24.8% growth recorded in August 2020. The slower growth was due to a contraction in the net foreign assets of the banking sector. Reserve money, on the other hand, increased significantly by 36.7%, compared with 20.2% over the same comparative period, largely reflecting the net build-up in the bank's foreign reserves, higher cocoa purchases than anticipated, and continued implementation of COVID-related policy measures. The banking sector remains strong and well capitalized, with stronger growth in total assets, investments, and deposits. Total assets increased by 16.7% to 166.4 billion Ghana cedis as at the end of August 2021, driven mainly by a 28% year-on-year growth in investments to 80.3 billion Ghana cedis. Growth in gross advances rose by 8.7% as at August 2021 from the end-June position of 5.7%. Strong liquidity flows during the period resulted in a 21.8% annual growth in total deposits to 111.6 billion Ghana cedis. Financial soundness indicators have remained strong over the period. The industry's capital adequacy ratio was 20.7% at the end of August 2021, well above the regulatory minimum threshold of 11.5%. Core liquid assets to short-term liabilities was 24.7% in August 2021 compared with 29% a year ago. Over the same period, net interest income grew by 17.9% to 8.3 billion Ghana cedis, marginally lower than the 18.7% growth a year ago. Net fees and commissions grew strongly by 21.8% to 1.85 billion Ghana cedis, higher than the growth of 8.9% for the same period last year, reflecting the continued recovery in trade finance related and other ancillary businesses of banks. Total operating income rose by 15.7%, marginally below the corresponding growth of 17% last year. Cost control measures within the banking sector continue to support profit performance, with operating costs increasing by 9%, lower than the 12.1% increase recorded for the same period in 2020. Loan loss provisions also increased by 5.3% compared with 29.5% growth a year ago. Profit before tax accordingly increased by 27.4% to 4.9 billion Ghana cedis, higher than the growth of 19.2% a year ago. Private sector credit growth has not fully recovered to the pre-pandemic levels due to lingering supply-side risk aversion from the shock of the pandemic, as well as slower than expected growth in demand for loans that are backed by bankable projects. Annual nominal growth in private sector credit slowed to 9.5% in August 2021 compared with 14.3% in the corresponding period of 2020. Similarly, real private sector credit contracted marginally by 0.1% compared to a growth of 3.4% recorded over the same period last year. New loans and advances by banks totaled 21.6 billion Ghana cedis in the year to August 2021, marginally above the 20.7 billion Ghana cedis for the same period in 2020. The non-performing loans ratio increased from 15.5% in August 2020 to 17.3% in August 2021, reflecting in part the general pandemic-induced repayment challenges, as well as some bank-specific loan recovery challenges. The latest stress test conducted on the banking sector shows that banks remain resilient under mild to moderate stress conditions, supported by the strong capital and liquidity buffers and the regulatory reliefs introduced during the pandemic. In addition, results from the latest credit condition survey point to a potential increase in demand for credit over the next 2 months. Commercial banks have also indicated a likely softening of their credit stance to households and firms in the coming months, a development that may translate into higher credit growth to support the ongoing recovery process. The specialized deposit-taking institutions and non-bank subsectors continue to reflect gains after the cleanup process. In July 2021, the balance sheet of the savings and loans, finance houses, rural and community banks, and microfinance institutions improved compared with July 2020. This was driven by a strong growth of 27% in deposits relative to 15.7% growth in July 2020. And gross advances also increased by 17.3% compared with a contraction of 19.3% over the same comparative period. Price developments indicate an increase in the general price level during the third quarter of 2021. 2 readings since the last MPC meeting showed significant increase in headline inflation from 7.8% in June 2021 to 9% in July and further up to 9.7% in August, closer to the upper limit of the medium-term target band. The upward trajectory of inflation was mainly driven by a surge in food prices over the period. Food inflation increased from 7.3% in June to 9.5% in July and then to 10.6% in August 2021. Non-food inflation also rose marginally from 8.2% to 8.6% and then 8.7% over the same comparative months. The above trends are beginning to reflect in underlying inflation as all the bank's core measures of inflation increase over the period. The core inflation measure, which excludes energy and utility, increased from 7.5% in June 2021 to 8.9% in July, and then to 9.5% in August. The weighted inflation expectations index also picked up in July 2021, reflecting higher inflation expectations by businesses, consumers, and the financial sector. Provisional data on the budget execution for the period January to July 2021 indicated an overall broad cash fiscal deficit of 6.1% of GDP against the target of 5.7% of GDP. This was due to higher revenue shortfalls. The corresponding primary balance was a deficit of 1.9% of GDP compared to the target deficit of 1.3% of GDP. Over the period, total revenue and grants amounted to 34.3 billion Ghana cedis, that is 7.8% of GDP, below the projected 38.8 billion Ghana cedis, 8.8% of GDP. Total expenditures and arrears clearance amounted to 61.1 billion Ghana cedis, that is 13.9% of GDP, which was below the program target of 63.8 billion Ghana cedis, that is 14.5% of GDP. These developments impacted the stock of public debt, which increased to 76.4% of GDP at 335.9 billion Ghana cedis at the end of July 2021, compared with 76% of GDP, that is 291.6 billion Ghana cedis at the end of December 2020. Of the total debt stock, domestic debt was 173.4 billion Ghana cedis, while the external debt was 162.5 billion Ghana cedis. Money market interest rates continued on a downward path across the yield curve. The 91-day and 182-day Treasury bill rates declined to 12.5% and 13.3% respectively in August 2021, from 14% and 14.1% respectively in August 2020. Similarly, the rate on the 364-day instrument decreased marginally to 16.2% from 16.9% over the same comparative period. Except for rates on the 15-year and 20-year bonds, which remained unchanged at 19.8% and 20.2% respectively, rates on all other medium to longer term instruments generally declined. The weighted average interbank rate declined to 12.6% from 13.6%, largely reflecting improved liquidity conditions on the interbank market, which had transmitted to lending rates. Consequently, average lending rates of banks declined marginally to 12.5% in August 2021 from 21.4% recorded in the same period of 2020, consistent with developments in the interbank market. International prices of the three major export commodities reflected mixed trends in the year to August 2021. Crude oil prices have remained bullish on account of OPEC Plus production cuts, which has led to steady draws on global oil inventories. The average price of crude oil went up by 40.4% on a year-to-date basis to $70.5 per barrel in August 2021. Gold prices declined by 3.9% to average $1,789.6 per fine ounce in August 2021 due to pressure from the strong US dollar. The average price of cocoa also decreased marginally by 1% to trade at $2,555.9 per ton due to ample supply from major cocoa producers. These price developments, together with production changes, impacted the trade account over the first 8 months of the year. Total export receipts increased by 2.4% on a year-on-year basis to $9.9 billion, supported by higher realized prices from gold, which was up by 6.2%, cocoa up by 4.2%, and crude oil prices, which was up by 58.1%. However, the impacts were moderated by a sharp decline in the volume of gold and crude oil exports by 20.9% and 20.1% on a year-on-year basis, respectively, despite the 23.9% growth in volumes of cocoa bean exports. Total imports, on the other hand, increased by 8.6% to $8.9 billion US. This was driven mainly by a 58.5% increase in the value of refined petroleum product imports, arising from increased demand as the economy returned to normalcy from last year's lockdown. The higher import bill relative to export receipts resulted in a lower trade surplus of $874.8 million US in the year to August 2021, compared with a surplus of $1.4 billion US recorded in the same period of 2020. Gross international reserves stood at $11.4 billion US, equivalent to 5.2 months of import cover at the end of August 2021. The strong reserves buildup over the review period provided some buffer to the local currency, which came under some demand pressures from commerce, manufacturing, and energy sectors as economic activity picked up in the third quarter. Cumulatively, available data as at September 22, 2021, shows that the Ghana cedi recorded a depreciation of 1.8% against the US dollar, compared with a depreciation of 3% for the same period of 2020. The Ghana cedi also depreciated by 1.6% against the pound sterling, but appreciated by 2.7% against the euro over the same period. Summary and outlook. The committee noted that the recovery in global economic activity has continued, although unevenly spread across regions and countries, but uncertainties regarding the continued spread of the Delta variant of COVID-19 virus, variations in policy stimulus programs, and low access to vaccines in emerging markets and frontier economies may weaken near-term growth prospects. Global inflation pressures are expected to be strong in the near term. However, the factors driving headline inflation are judged to be temporary. There's still sizable spare capacity in the global economy, and the slackness in labor market conditions would restrain wage growth and prevent a significant and sustained pickup in underlying inflation. Inflation is expected to return to their targets over the medium term as the spare capacity is eroded. Global financing conditions remain generally supportive of the recovery process despite rising inflationary pressures. However, the strengthening of the US dollar, rising US inflation, rising long-term bond yields, and anticipated earlier than expected tapering of bond purchase programs by central banks in advanced economies have heightened uncertainties in the outlook. In some emerging and frontier economies, particularly those with high fiscal deficits and debt vulnerabilities, these developments have triggered capital flow reversals with associated currency pressures. On the domestic front, the committee was of the view that growth continues to recover from the impact of the pandemic. High-frequency economic indicators point to continued recovery in economic activity, even though below pre-pandemic levels. Although consumer confidence picked up, weakening business sentiments stemming from supply disruptions is adversely impacting input costs, driving down short-term company prospects. While credit to the private sector saw a marginal pickup, the trends remain below expectations, largely on account of pandemic-related risk aversion. The COVID-19 related macro-prudential measures put in place by the Bank of Ghana will be maintained for the time being to support full recovery in economic activity. The banking sector balance sheet performance remains strong, with sustained growth in total assets, investments, and deposits. Profitability levels remain high, with profit growth driven by increased income growth. Financial soundness indicators remain broadly sound, although credit risk appears elevated and needs to be carefully monitored. Bolstered by strong capital and liquidity buffers, banks are expected to withstand mild to moderate credit risk shocks emanating from deterioration in asset quality. Banks continue to increase their investments in high-yielding government securities to improve their earnings, while moderating their credit risk due to uncertainties in the business environment. The committee took note of the fact that the trend of increased domestic financing of the deficit, driven by high-yielding government paper held largely by banks, was crowding out credit to the private sector. The external payments position remained strong despite the decline in the trade surplus due to a stronger import growth and a widening current account deficit, which has been adequately financed with external inflows from portfolio and foreign direct investments. The Ghana cedi has performed strongly with a year-to-date depreciation of 1.8%. The country's higher sovereign spread has not shifted foreign investor behavior as net monthly purchases of securities on both the debt and equity markets remain favorable. In the outlook, rising interest rates in the advanced economies on account of tapering may pose some risk. However, the strong reserve buildup and foreign exchange inflows from the recent SDR allocation and the expected syndicated cocoa loan proceeds should help to cushion currency pressures in the near term. The latest data suggests that fiscal consolidation efforts appear to be on track, but with some inherent risks associated with wage settlements and energy sector payments amid low revenue mobilization. In addition, debt sustainability concerns remain, which warrants additional fiscal consolidation efforts, carefully balanced with sustainable growth strategies and efficient debt management strategies. The expectation on fiscal policy implementation in the remaining months of the year will be shaped by revenue collection efforts and strict alignment of expenditures with revenue inflows to ensure the attainment of the fiscal deficit target for the year. Inflation has risen sharply over the last two readings, driven mainly by sustained food price increases. Although food inflation has pushed overall inflation close to the upper limit of the band, core inflation remains relatively subdued. In the view of the committee, the increase in inflation is mainly due to food inflation, which is expected to abate with the onset of the harvest season. This notwithstanding, the latest forecasts indicate that inflation will remain within the medium target band, but closer to the upper limit in the near term, in the absence of further unexpected shocks. A close monitoring of the inflation situation is, however, warranted to respond swiftly to prevent potential second-round effects on headline inflation from the rising food inflation. The committee stands ready to respond appropriately as needed if this particular risk materializes. Given these considerations and the fairly balanced risks to inflation and growth in the outlook, the committee decided to keep the policy rate unchanged at 13.5%. Thank you very much.